Today, folks, for the first time this year, our portfolio surpassed the $1 million mark between the wife and I with the piece of real estate we purchased last year to our portfolio is absolutely exploding this year. And I want to analyze the performance of my personal accounts to give you an idea of where I was to where we currently sit today with our top 5 holdings in our combined accounts. And then we're going to get an idea of where the market sits moving forward with my personal predictions analysis. So if you are on a path to financial independence, if you damn well one day want to retire early, go hit that subscribe button, as my portfolio is closely approaching the 350K mark, and we're going to delve into the individual accounts. And if you want to learn more about like the wife and I and how we kind of manage our portfolios together, go to kylelivingston.com and get my lifetime access to my private courses. This is where I really pull the veil back and show you stuff I do not reveal on this YouTube channel. Prices are going up next year, and thanks to all of you that have been supporting thus far. Link in the description below. But we'll start with, first and foremost, the longest running account I've ever had. And I have not put money in this account now in a couple years. It's just been flatlining, and yet it's still able to dramatically outperform the S&P 500. I think it's well up over like still 100, 150, 80% or something like that over the S&P. But I want you to really look at this time period here, because what always just fascinates me is when I started investing, my accounts dropped by like 40%, and I didn't even see a starting rate of return for the first 2 years. Starting in September of 2014, didn't see anything really till about September of 2016. And I want to remind you, if you're struggling trying to figure out your path in the financial markets, just know that, you know, I went through some insanity too. I didn't see gains for years. I struggled in the beginning, and look at the perseverance and how much it paid off, because an account that I haven't really touched in years is still dramatically higher in its return. The S&P hasn't even come close to catching up just yet. Humble brag, I know. As we take a look at the tax-free savings account, this is one that most people are a little bit more familiar with. I've been a little bit more conservative, and this account is only up, I think, 80% more than the S&P 500, and thanks to some recent positioning, some good trades in Tesla this year. Google's actually started to excel. We've done fairly well at outpacing the S&P continually, as again, I took money out of this account to purchase that real estate purchase last year, so it flatlined and didn't do anything for quite a few months there, and yet still we're able to outpace the market. If we take a look at the actual holdings in my tax-free savings account today, as many of you know, the 2 single stocks that I've started to accumulate in here is Aduro and Google. Google was just a lucky timing. I don't know, it popped off pretty heavily on that recent announcement of the quantum computing chip. Google I hold between all of our accounts and has now become the largest single stock position that we hold, because I bought it in my corporate account. I own it here. The wife owns a lot of it. We loaded pretty aggressively into it. Otherwise, yeah, Aduro I'm still trying to accumulate. I'll be buying more before the end of the year, along with VDY, and I'll keep cost averaging to the S&P. But the gains in here are pretty nice. Let me zoom my head out of the way just so you can see. I mean, we're up about 8% on VDY, 18% on the S&P, 10% on Google as it stands, and we're down about 5% on Aduro. If we take a look at the RRSP, which by far is the best performing account, hands down, and again, this was all on the back of Tesla back in 2019 as I sold the position mostly off to start cost averaging into SCHD to again get the dividend income up, look for more stability, as again, now I'm moving from the crazy growth phases of my portfolio more to the preservation phase, in my opinion. You know, we've gotten so much money invested, it becomes a lot harder to manage with individual stocks that we've kind of realized putting most of our eggs into ETFs and then taking about 10 to 20% of our portfolio and picking the stocks we love to try and outperform is the healthier, approach for us. Maybe not for you, but for us personally. And the RRSP is up 341% as of November, the end of November coming into December, whereas the S&P is only up 102% in the same time period, which is just staggering to me. And SCHD has been doing quite well, not as well as Tesla has, obviously, but we're still up 13.29%. Again, I'm looking at drawing dividends out of here long before I reach 65. A lot of you are aware that whatever you put in this account, though it waives the withholding, there's 15% on dividends from US stocks in most brokerage accounts, except for this one as a Canadian. And I'm trying to take advantage of those dividends sooner rather than later, because again, I'm looking at utilizing this income in the next 5 to 10 years rather than waiting until I'm 65. So that's kind of the goal with this account, is to just keep accumulating SCHD in the coming years and then eventually have a very nice dividend snowball that until I reach that ripe old age of retirement, I can just keep drawing some dividends out of here without touching that beautiful equity. Now, the account that I haven't touched on as in-depthly that is going to be more geared toward my course material because it's far too complicated and technical is my corporate account. This account I haven't been as crazy with because I ended up selling a lot of my individual, tech companies and all that back in the day to primarily just focus on the S&P, and we've basically been just in line with the S&P's performance since. But again, I do have some more stocks in here we're going to talk about in that course material. We're going to talk about tax efficiencies, why I'm investing within this account. But for now, I'm going to save that for another day, and I'll probably shed some light on this YouTube channel as well. But let's boil it down to the top 5 stocks. It makes up 6 figures of our portfolio. Over 20% of our portfolio is really dictated by these handful of companies, and these are by far the largest positions between the overlap in the S&P 500 and our ETFs and the individual positions we hold. And I really went down and actually did the math on how much money we have in these stocks. But Google right now, as the recent purchases, has put it at the number 1 position. I think in our combined portfolios, it's something closer to 6%, but it is the largest position that we now hold, and it makes me sleep so easy at night. And I have a very high conviction into where this company is going, just because the value metrics today, along with all the hype potential from self-driving, from quantum computing, Google, is on the forefront of AI. It's doing so much, and it's still able to grow on the back of the concerns that they're going to lose, search dominance to other players. But I honestly think as their cloud computing grows, YouTube continues to scale, we're going to start seeing search dominance actually bleed as a smaller piece of the pie. It might alleviate some concern in the coming years, but in the meantime, it is starting to consolidate after the massive rally from the quantum computing hype. Meta is our next position here. I actually have my Oculus right here. I still use this thing probably 3-4 days a week at the minimum, and I love it. I still believe Meta is, again, one of the best buying opportunities in the S&P 500 today for the value you're paying versus the future growth potential. I also use Meta's AI tools a lot because they've integrated them into WhatsApp and Messenger on Facebook. Even though Facebook, Instagram, all that went down briefly this week, which I don't know if you guys were aware of it, but most of us, our hearts were fluttering a bit trying to access some of our accounts. But yeah, Meta's super awesome. Apple comes in at number 3, and this is my most concerning, but it mostly just comes from the weighting in the S&P 500, and the wife does own some individual shares. This has been a killer stock for us this year, absolutely crushed. But I do have some concerns that we'll talk about when we kind of look where the market's headed into 2025, because man, this thing has not been growing fundamentally, yet the value is just absolutely exceeded a 40 times multiple, which is kind of getting a bit excessive in my opinion. The 4th largest stock is Microsoft. Again, another sleep easy at night stock. It actually trades at a better value right now than Apple, and I think it's a better buying opportunity than Apple in the comparable value metrics. So it'll be neat to see what happens with this guy. And then finally, on the Canadian side of the border, Royal Bank makes up our 5th largest position just from the weighting that we have in it in VDY. And VDY is, again, a 6-figure position between the wife and I, but because, a lot of that money is flooding into the 15% weighting in Royal Bank, when I looked at the math on it, it actually floated into being the top 5th position in our portfolio. And I'm super fine with that. I love this being a core holding, and it's also, actually excelled some of the performance that we've seen in, Microsoft. And it's really interesting to see a Canadian bank actually keep up with tech-like performance. So putting that aside, if we take a look at the markets today and how I feel about them, I really feel like we're in an overbought, frothy, FOMO-like market that is comparable to where we were in 2021. Heck, we all know we're kind of sitting in this market. I don't think there's anybody sitting there watching vertical lines thinking that this is a healthy, normal market. We're literally, our price to earnings multiples are going right back to where we were in 2021-ish time period. 2020 was just such a hype period, when the money printer started turning on. I don't know what's really driving a lot of this hype right now, but it kind of makes me feel like crypto's a bit overvalued if stocks are as overvalued as they are. It really kind of just tells you that the market as a whole is probably broadly overvalued, and we're seeing it from mega multi-billionaire investors, right? Like Berkshire sitting on record levels of cash. I feel bad for Berkshire shareholders, because with the money they've had, they should have been able to take more advantage of the pandemic. Many of the crashes that we've had in the market, Berkshire, no offense, has done a horrific job at managing their cash. And then when we go into these kind of markets where things are clearly frothy and they're like, let's sell some Apple, let's sell some stock, let's stack cash just for the weathering storm that might be coming. The problem is they never take advantage of the storms. They just kept stacking cash and stacking cash. And you can tell they're concerned about this market environment, but they just don't take advantage of it when it turns the other way. I've never seen them do a good job at managing their cash in that aspect. And I know I'm being critical. I know the guy has done far better than I have ever done. But I mean, you do have to recognize that they missed out on some massive opportunities, and Apple is just not that opportunity like it was in the past. Now, everyone is expecting that growth is going to start to recover in 2025. That's what the market is pricing in right now, but we haven't seen it actually come into fruition. We haven't seen it actualize. If you take a look at Apple's earnings here, they have flatlined basically since that peak period we saw in 2021, and we are now back to valuations in Apple never seen in its history on the back of no growth. Keep that in mind. We have no earnings growth, yet we are trading at levels never seen in Apple's history. This is why Buffett has been selling in the position, right? You take a look at hype stocks like Tesla, for example, and Tesla's a good example of everyone is expecting something very big to come very soon. I mean, you look at the expectation that caused the 2019 rally, and that led into just absolutely incredible revenue growth. But again, we have no growth right now, and here we are trading back at levels like we are growing at the pace that we were. So coming into 2025, past this chart, we need to see some vertical lines in revenue and earnings and everything else, or this market is going to slap you upside the head if you are not very cautious with how you approach it. So the thing that I'm paying most attention to that is going to benefit these tech companies, but I think is going to be more intriguing for real estate, infrastructure, utilities. I know a lot of people still sideline the idea of these dividend stocks, but this is where the value actually sits, guys. I'm still looking at a ton of dividend companies that are just trading at really low values compared to the historical averages. They have a lot of potential on the back of interest rate cuts and the interest rate recovery next year. The US needs to cut a bit more aggressively before we're going to see it on the US side of the border with stocks like SCHD. On the Canadian side of the border, we've been seeing the effect in some of the the REITs and some of the dividend ETFs, because like VDY, the stock performance has actually just started exactly going in line with the interest rate cuts. So I think as we see this get more aggressive and coming into 2025, probably by the second quarter, I would think we'll start seeing the materialization of cash flow return to some of the interest rate recoveries. We've talked about this with telecom giants and utilities. The bank should start seeing some easing on loan loss provisions. And I really think we're going to get a good boost. So I'm very happy with where I sit, presuming there's no black swan. Tariffs could really put a tailwind on a lot of this stuff. Again, I am not a fortune teller. I don't know what's going to happen. This is why I broadly diversify into the best balance sheets, what I consider to be the best valued companies, and I hope of outperforming the broader markets, right? I think Google, Meta, for me in 2025 is where I'm much happier sitting. If the market does correct, I still think these things will not correct as aggressively. There's obviously variables in there, but just for the values they trade at today, I don't know what else is worth buying with the exception of some small caps that many of you are aware I'm now purchasing within my accounts. So I'll pass the question off to you. I'd love to know what you're doing. What are your top 5 positions for 2025? I'd love to hear about all of it in that comment section below.